So let's think about today's little content piece. Strike while the iron is hot. I was trying to find some fancy graphics. I did have grandiose ideas of trying to, and unsuccessfully and very tenuously connecting to The Empire Strikes Back, which is showcasing at my local cinema this weekend. So I may take a journey out, but it really is just loosely my jokey attempt to try and relate strike prices to something Star Wars related. Hey, you know, go figure. When it comes to options, though, just bringing it back on track, options they're nothing really to be scary about. They're always referred to as, and this for me is the huge fucking lie of Wall Street. They're advanced, they're high risk, they're not. You shouldn't trade them. You know, as a retail trader, you want to be wary of them. And all this is Wall Street's efforts, continued efforts to put the fear of insert your own deity name, the fear of whatever into you as a retail trader to stop you from trading the smart way. And I'm not saying it's the only way, but it is a smart way. So all that it's doing is creating fear. So put your fear to one side. Options are simple. Let me say that again. Options are simple. There's a lot of information. I'm not going to say that there's not a steep learning curve. There is. But options are simple. Just like learning to drive. When you first learned how to drive, it was probably really difficult, but it's not complex. It's difficult, but not complex. And it's only difficult because at first there's a lot to learn. There is a steep knowledge gap to bridge, just like when you learn to drive. If you think back to whenever you've learned anything that was a little bit more technical, at first it seems hard. But let's fast forward. In my case, let's fast forward 30 years. I've been driving a while now. I know what to do. I don't think about doing it because I've done the hard work. And it's only a knowledge thing. From a skill point of view, it's an easy skill to learn. But at first, there's a lot of knowledge. And again, that's what I'm trying to separate. So options for me, and I always think that they are simple. They're not complex when you get to know. Just like driving, it's not complex. There's just a lot of information. That's all I'm trying to say here. So what we have, this is when people talk about options and when you pick up a textbook, this is usually what is presented to you. And I don't think that the textbooks do a very good job of actually explaining what is going on. And again, I remember my early days of reading the options stuff, and it never really explained it satisfactorily. And all this is a representation of the P&L, the profit and loss. So if this is the stock price down the center, and let's just say that that's $100 up here or infinity, whatever. So if the stock goes to zero, then you might lose money. So we're talking about buying a call. So you might lose money in that area. So if the stock goes down, you would lose money. If the stock goes up, you would make money. And that's exactly the same as buying stock. Just think about it. If you buy stock and the stock goes down, you'll lose money. If it goes up, you'll make money. And that's all this graph is showing. And in the case of stock, that loss line, that can continue to go down and down and down. If you don't close the trade, you will lose. You could possibly end up losing every penny invested. And if you're on a margin account, you could end up having what's called a margin call. You will owe the broker money. And that's what's happening. You may have seen some nightmare stories of that. So owning stock is actually more risky than buying a call. So if we buy a call instead of buying stock, then that's what this horizontal line is. The loss stops. Well, let me say that again. The loss stops. It's fixed risk. So on face value, if you just bought one option, which controls 100 shares, instead of, and compare that to buying 100 shares with no stop loss, and you just come back in 6 months, You buy a 6-month option and a 6-month and 100 shares and come back in 6 months. And you may be making money, you may be losing money, but the worst case is if you lose money, if the stock goes down, you're always going to lose money. But with the stock, that could be a big chunk of change. With the option, it's defined. Does everyone get this? Again, I appreciate some of you already know this, but this is just what I'm trying to point out. That's what this graph shows you. Options have a fixed, defined risk on the entry with no stop loss. Let me say that again. With no stop loss, your risk is defined. So I've really got to ask that question. Why is this riskier than buying stock? Why is it riskier? It's not. It's actually safer, more secure than buying stock. So Wall Street's lying through their hand teeth that it's more, there's more risk involved, it's dangerous and you shouldn't do it. Like, I shouldn't cross the road without looking. That's pretty dangerous, but I still do it. So Ezekiel, great. So thanks for your, I can see the comments there. Thank you. So Ezekiel, thanks for the sensible view and approach. Appreciate that. So thanks for the comments. So what I'm trying to point out is that, yes, I'm a convert of my own system. Yes, stock options are great. And there's disadvantages as well. We can cover those on another day. But just on that face value, this lie that Wall Street's told you, options are complex. Options are more dangerous than buying stock. It's absolute lie. It's absolute bullshit. And this graph, that's what this proves. If you buy stock, you could lose everything and possibly have the broker phone you to say you actually owe us money if you've got a margin account. But with an option, the price paid is the price paid. That's it. The price paid is the price paid. Just like a deposit in the real world. If you wanted to buy a car is the metaphor for stock in this little story. If you were to buy a car and you said to the car dealer, I'd like to buy this car, but I'm not going to pay you till the end of the month. There's the time here, the expiration, the end of the month. And they're going to say, yeah, just leave a deposit. That's all we're doing with stock. We're not buying the stock. We're reserving it. And we get to say to our broker if we want to take it at the end of the month or we want to sell the option back to the market. And we may be able to get some cash back if we're losing money. But if we're right and the stock increases in value, then we should be able to make some money. And that's what we highlighted earlier. You know, that's how these, I'll just go back to these trades. That's how these trades made money. You know, WPM, I didn't buy stock. I bought an option and the stock increased in value and therefore the option increased in value. And in this case, the option made 100%, 109% return on capital. So it's a lot more secure. Now, if it had gone wrong, then the worst case scenario, well, we'll look at the price. $2.60. So one option would have cost me $262. My worst case scenario, I'm just looking down here. Let's change the colors. Just looking down there at the broker statements, $262 is what it would cost me. So one option contract, $262. That's it. That's the worst case scenario. That if the market had sold off and gone to zero and crashed again, worst case scenario, $260. So they're not riskier than anything else. In fact, if anything, stock is a lot more risky. Anyway, that's not help us with strike prices, but this is ultimately what we are looking at when it comes to the P&L statement. So when it comes to options, what strike price should we choose? Now, I have a few possibilities that I like to use, and this is what the option chain looks like. So you'll see it's expanded, and we'll look at it on the platform in a moment. So how did I choose this one? So what I'm looking for is that there's lots of expirations that I could choose, but I'm looking for the one that is at least 45 days. So this number here in brackets, these numbers specifically in brackets, they're telling me how many days to expiration. And this particular one has 49 days. That's the one that's nearest to 45. I'd rather have a little bit more than a little bit less. So I'm going to ignore all those and just focus on that one or any of the others. But it's going to be at least 45 days. And for me, that's usually my default selection. So what that means is you can zero in on, okay, there's the one that I'm going to look at straight away, and I can ignore the others. So when we're thinking about the expiration, how much time do we need? So for me, why this one? And just the back of the envelope, there's lots of reasons. And when you get into options, you can start to figure out which expiration will be best for you. But for my style of trading, my average time in trade is about 20 days. Therefore, having at least 20 days is important. Now, what I like to do is have at least twice as much time than I actually need, which is why I'm looking for, 40 plus days. So 45 is one of the expirations. That's the one that I like. There's lots of other reasons, but it's going to be at least 45 days. And occasionally I'll go more. It depends on the situation. And as you get used to options, you'll be able to figure that out for yourself with time and experience. So now that we know which expirations to go for, give yourself enough time. Better to have more time than less time, in my view. I've highlighted three options here. And how did I pick these? I looked down at this column. So this column here is referred to as delta. So I've highlighted in the money. So it's an option that's got both time plus stock value. I've got an out the money option, which is just time. That's what out the money is. I'm just buying time. In the money, I've got time plus a little bit of stock value. And then there's at the money, which is the strike price right next to the current stock price. So they're the three things: in money, out the money, and at the money. Appreciate there's lots of new terminology here. My purpose is not to explain the terminology. It's just to kind of very quickly just give you like, which strikes do we buy? So I'm looking for strike selection. So I'm going to make my choice of which strike to buy in between the two red bands, the in the money extreme and the out the money extreme. So why these two strikes? So I've got 70 delta. So I'm looking at the delta column again. I've got that 70 delta strike, and then I've got 35 delta. And I can choose any of the strikes between those. And usually it's either 70, 35, or 50 delta. So in the money, out the money, at the money. And they're the three choices. Let me just pause there for dramatic effect. We've got time. I've got enough time for the trade. The second thing is, which strike do I buy? It's going to be one of three. Ooh, where's my little thing? It's going to be one of three. 1, 2, 3. One of three choices. In the money, at the money, out the money. In the money, at the money, out the money. So three choices, and the in the money opening bell. In the money is 70 delta. At the money is 50 delta. It's usually 50 or less. It's usually one strike out the money is my choice for the at the money, and then we've got 30 or 35 delta. Either is fine. So we've got three choices now. So we're narrowing things down, and again, I'm going to ignore everything in between. I don't need to worry about the other things. So in the money, at the money, out the money, 70, 50, 35, 70, 50, 35. So why those three strikes? Let me just pause here. Is everyone still keeping up? This is a little bit more technical. It is being recorded. You can watch it back later, but does everyone kind of get that? I've only got three choices. That's the takeaway here. In the money, out the money, sorry, in, at, and out, 70, 50, 35. Awesome, awesome. Thank you, thank you, thank you. So we got Enoch, Greg, John, perfect. In the money, at the money, out the money. Let me just, if you write it down at 70, 50, 35. In the money, at the money, out the money. So why is this important? Let's go to another graph. In the money, at the money, in the money, at the money, out the money. So let's just think about this. Ooh, skipped ahead, wrong one. There we go. So in the money, at the money, out the money. So if we imagine that the center there, 50 delta, 1 delta, 0 delta. So this here is 50 delta. That's where this. So if this was the speed of the P&L, speed of the profit and loss. So if I'm buying an at the money right next to the current stock price, so the stock price is right there on that dotted line. And if I buy an at the money option, then I've got a little bit of acceleration. I will make money reasonably fast, and then the pace of profits steadies out. Let me say that again. I'll make money initially fast, but the pace of profits will slow down. The rate of change will slow down. And that's okay. So why would I buy a 50 delta option? Now, this is my default selection for reference. I'll say that again. This is my default selection. So the at the money, usually one strike, the first strike out the money. And the reason why I typically buy that is I'm just buying time at that point. So that's the first thing. I'm just buying time. That's what one strike out the money means to me. But if I'm right, then it will make money straight away and start to accelerate quite quickly sooner rather than later. If I'm wrong and I'm losing money, then I'm going to lose, and all I'm losing is time value. That will make more sense in a moment when I explain the other ways of doing it. So all I'm losing is time value. But if I'm right, it accelerates reasonably fast. It's not accelerating the fastest, but it accelerates into a profit quite quickly. And that's what at the money means to me. So my usual selection for a stock, for an alternative, a replacement for stock, is usually one strike out the money. And it's the first strike out the money. That's my default view most of the time. And this is the reason, because if I'm right and I get the direction, then it's going to accelerate. It's going to jump. Oh, where's my widget? There we go. It's going to then suddenly have, so if I'm right and I'm just going to have time plus stock value very quickly. But if I'm wrong, I'm only losing time. Great. That's my choice. Cheers, Glenn. I appreciate your comments. Thank you for your feedback. Glenn's enjoying it. It's wonderful. So this is my choice. Let me just say that again. 50 delta, it could be anywhere between 50 and 40, just for reference. It depends on where the stock price is. We'll see this in a moment. But if I buy one strike, the first strike out the money, all I'm buying is time. But if I'm right, it's going to gain, and this is how I'll make money. It's going to gain stock value quite quickly. But if I'm wrong, all I'm losing is time. That's all real. So that's the first one. So that's the yellow box there. That's buying the at the money option. And in this example, I don't know if you can just see, I don't know if this is projecting well, and I'm just focusing on the call side. So the stock needs to increase. In this example, so if we're buying stock, it's the equivalent by buying a call. So you can just see that it's slightly shaded differently, and it's that first strike out the money, and then that one there is the first strike in the money. So in this case, I would buy that 186, and that's the first strike out the money there. That's what we're talking about. So that will, and you can see, if you looked at the numbers, it doesn't matter whether it's the buy price or the sell price, but you'll see that if I'm right, if this goes from out the money to in the money quite quickly, and that the stock accelerates, you'll see that you'll make money quite quickly. But if I'm wrong, all I'm losing is time, and I'm losing money at a slightly slower rate. And that's the important part. And that's why I like that price. Fast, slow, and all I'm losing is time. So then the second choice is, I'm going to go through these things first. So this one here on the left, this is the out the money option, out the money. So if I was to buy, so at the bottom there, if I was to buy that out the money option at 35 delta, if I bought the out the money option at 35, so if I buy that one, it's going to correspond to this area on the graph. So that's the 35 delta. So that'll be 35 delta. So why would you buy an out the money option? Why don't I buy a 20 delta? And this is where or a 10 delta or a 5 delta? Why don't you buy those? Because it's fucking stupid. That's why. It's the short answer. It's not that it won't work. We've got to, whenever we're buying options, it's a trade-off between when we make money. So this 35, it's about 30, 35 delta. If I buy at the 30, can everyone see that this is a very shallow S curve? It's a very shallow S. This, can everyone see that before I move on? Can everyone see that this is a very shallow S? Perfect. Cheers. Thank you, thank you, thank you. Yes, yes, yes. Great. So that's the important part. So that box there, 35 or 30, 35 delta, depends on which way the wind's blowing, but 35 delta, that's at that bottom of the S, the bottom of the S. And if we were looking at this in terms of a bell curve or standard deviation, that would be a 1 standard deviation move. And mathematically speaking, this is where normal and abnormal stops and starts. Let me say that again. Abnormal in mathematical terms starts and stops at 1 standard deviation. And what we're trying to do is we're trying to find the balance of, well, if the stock moves and does what I think it's going to do, I want to make money as soon as possible. So let's just run a scenario. If I was to buy this 35 delta option, I'm right on the S. Can everyone see here that at that S there, the bend in the S, I've got maximum acceleration up to here, which correspondingly is going to be 70 delta. I've got maximum acceleration. Can everyone see that? Maximum acceleration. Perfect. I get lots of yes in the chat box. So why would someone buy 30 delta versus 20 delta? So if I buy 20 delta, I've got no profit, no profit, no profit, no profit, no profit, no profit, no profit. So the stock has got a long way to travel before we hit the acceleration. Compare this to, I'm going to drive my car in first gear for 10 miles, then I'll change gear to second. And at that point, I'll go second gear, third gear, fourth gear, all the way up to fifth gear. But I've got to drive 10 miles in first gear first. And that's why buying a 10 delta or a 20 delta or, I'm not going to go below 30 delta. And this is what the bro traders, the Robinhood traders, the lottery ticket traders, they're going to buy deep out the money options at 5 delta because it's kind of working, because we've got this weird market at the moment. Buying a 5 delta option for pennies and buying 1,000 of them on Tesla, it's kind of working because Tesla's moving $1,000 every other day at the moment. All right, a dramatic exaggeration, but it's not normal. It's not normal what we're experiencing, and it's not a long-term strategy, but this is. So how do we choose the selection? I'm gonna start off in first gear, and very quickly I can go to second, third gear, fourth gear, and then all the way to fifth gear. And then I can cruise along at fifth gear profits. And that's what that means. So if I'm losing, so here's the thing. So the analogy is, if I buy a 35 delta option, then I've got 5 gears to accelerate. From the 50 delta, I'm starting off in third gear. And if I'm wrong, let's think of this. If I'm right, I'm going to make maximum money at maximum acceleration. And the reason why I might buy a 35 delta is I can get like multiples of contracts. Instead of 1 contract, I could buy 5. Instead of 1 contract, I could buy 3. For the same capital outlay, I can multiply my number of contracts. So that's why you would do this, but it's not going to be lower than that 30, 35 delta. So if I'm wrong, I'm going to lose money in reverse. That's it. I'm going to use the car analogy. I'm going to lose money in reverse gear. let me say that again. I'm going to lose money at a slow rate versus if I'm right, I'm going to accelerate into profits quite quickly. And this is how let's just go back, let's tie into this. This is how this trade made money. This is GLW. We actually had the same principle applied to wheat and precious metals. So this is how we did that. So at this point here, I bought a 30 delta option. So I'm buying out the money. And as price accelerated, then I went from 262 to 550. So I was able to get that 100% plus return on capital because my acceleration on the option went from first gear to fifth gear. Now, sometimes it just goes to third gear, and that's fine. But in this case, it went from first gear to fifth gear. Now, if I'm wrong, if the stock had sold off, then I'm going to lose money at the slow rates, and I'm only going to lose money in reverse gear. I've only got one gear to lose money in. But if I'm right, I've got 5 gears to accelerate. So that's how we can choose what we want from the trade. Now, that selection using the 35 delta strike, 35 delta in this case, that selection choice, you're going to need to have evaluated, is there the possibility for a reasonably big stock movement? Can I get my five gears of acceleration? Can I get that? And if you can't, then buying that strike price doesn't make sense. You're best defaulting to the 50 delta, because then you're going to make money from third gear. You're still going to lose money. You've got a little bit of downshifting in the gears, if you like, but then it slows down. So if you want to think about it in that gears terms, that's pretty decent. So let's think about the fifth gear. Let's buy. What about buying? So before I go on to the next part, I think everyone can see where this is going now. Does that driving in gear metaphor, does that make sense? Was that crystal clear? Because again, I appreciate this is a little bit abstract, but that 35 delta, we've got that fast acceleration and slow deceleration if we're wrong. Reverse gear, and then we've got gears 1 to 5. So the 70 delta, perfect. Thanks for your feedback. Thank you. So buying the 70 delta strike means that I'm already in fifth gear. I think because everyone got the explanation, do I need to explain this in any detail? You're buying stock in fifth gear. Now, this is what people would refer to as a synthetic stock position. Synthetic stock. So why would it be considered that? Let me bring it all together. If you buy stock, let's say if you buy 100 shares, it's worth it would be saying 1 delta. So you're buying an option that has the equivalent of 70 delta. That would be the equivalent of buying 70 shares. So that's what this is. That's why this would be a synthetic stock position. So when would you do that? You could do, instead of buying stock, you could buy a synthetic option, synthetic stock position, and you could apply essentially a covered call strategy. You can do this income trading that people talk about without the huge capital outlay of buying shares. You could buy in the money option, deep in the money at 70 delta, and the amount of money that you make is going to increase at a slow rate, but you're going to, I'm sorry, I'm not explaining this last part well. It's not going to increase in deltas. That's what we're talking about. So it's going to go from 70, 72. So the rate of change is what we're talking about, not the profit, the rate of change. So you'll make good money. But the rate of change from 70 to 80 to 90 to 100 deltas, you're only going to get 100 deltas on the day of expiration. So you'll make good money is all of it. You know, it's separate from the amount of dollars that you'll make. But from from the rate of change point of view, you're in fifth gear. You're already accelerating fast. You're making money. So you're buying the option at that 70 delta level. So the rate of change of further dollar gains is already going to be at a fast rate. It's very close to buying stock without having to buy the stock. So that's what we do. And that's what these three levels are. Let's go back to this. That's what these three levels are. We've got the 50 delta, the at the money. We've got 70 in the money and 35 delta out the money. My usual two, my default is 50, and I will evaluate the, to be fair, usually I'll go 30 delta. But usually they're the two strategies that I use. I don't often buy 70 delta because you've got time plus the stock value. So if I'm wrong, I can lose money on the downshift from 5 to 4 to 3 to 2 to 1, then reverse. I've got the opposite problem. But if you're looking for a synthetic stock position, then that makes sense. If you're looking for just time, and if you want to start making money fast, if you're right, then that's great. And then if you want to maximize potential profits, and you would maximize potential profit by, using the 30 or 35 delta so that you can get a multiple of option contracts. So let's just do a quick illustration. So maybe you've got a $500 risk. You can buy one option on, this is Apple. Yeah, cool. So you can buy one option on Apple, but if you go to 30 delta, all right, it's a little bit over $500, but you're close to. You could possibly get two option contracts on something like Apple. Again, when you look at wheat and precious metals, you go from 2 contracts to 10 contracts. It suddenly becomes a huge multiplier very quickly. So that's why you might do this at the money or out the money. And then if you want a deep in the money, if you want a synthetic stock position, then you're going to be looking at $785 versus $500 versus $275. So you can pick the most appropriate strike price. And when you know that this 70 delta, 50 delta, 35 delta, let me just do that again, 50 and 35. So when you know those three things, it means that you can ignore all the other strikes. And again, until you get more familiar with options, and as your knowledge and experience grows, you will learn like when the right time to look at all the other strikes, because there's lots of strategies out there. But just as a very basic stock replacement strategy, which one do I want to do? I might want to have a synthetic stock. Like right now, I'm a little bit over. We've got the opening bell. I'm going to trade Facebook probably very shortly after I've pressed finish on this trade. I'm going to use an option to do it. And instead of buying 100 shares of Facebook or Apple or whatever, I can buy a 70 delta option, a synthetic stock trade. And I can day trade with options instead of buying stock, instead of having a huge capital outlay of buying, if I was doing Apple, it's 100 shares times $180. That would be my requirements. Whereas buying one option at 70 delta, it's going to cost me $760. So comparatively, it's significantly more cost effective. So that's when I would, again, it's what I'm planning to do shortly. Just in this example, you can see that it's significantly more cost effective. So you could, in theory, day trade with a small account if you chose to. And obviously, you still got the pattern day trader rule. You can only trade three times in a 5-day period. But it just means that you don't have to worry about, like, I've not got the money to trade a stock like Facebook or a stock like Apple or a stock like Google. Well, actually, if I buy a 70 delta strike, then it's only going to cost me maximum, worst case scenario, $785. That's the requirements. Now, I'm not going to lose all that. If I'm not seeing my trade go my way, and maybe if it goes $2 against me, then maybe I'm only going to lose $200. I'm not losing, but my worst case scenario is 700. So it's or the capital outlay is going to be $780, but maybe I'll only lose 200 because I can sell it back to the market if it's not going my way. But that's one of the benefits of what we do. It's less capital intensive. There we go. That is option strike selection. Option strike selection. So just the back of the envelope, the summary version is 70 delta for a synthetic stock, 35 delta if you think there's going to be a bigger move and you want to get a multiple of contracts. And my default is 50. It's usually between 50 and 40 delta. It depends on where the stock price is. It's the first strike, one strike out the money. And they're the three choices. So when it comes to option selection and strike selection, I'm going to make sure that I've got at least 45 days, and it's going to be one of those three strikes. And then that means that it simplifies everything. I don't need to worry about all the other strikes around those 3 points. I can just ignore them and just focus on those three strikes. And that's how we choose option selections the AntiVestor way. As always, thank you for your time. I don't think I see any comments. I think everyone was keeping up. I don't see any questions or follow-on questions, but once again, thank you for your time. Thank you for your attention. And if you need a little bit more help with your trading and would like to know if what we do is right for you here, then you can start by taking a look at the basics training. Maybe today's your first day and you want to learn a little bit more about the basics. Maybe today's session was a little bit too much for you and you need to know some of the jargon. That's what this program's for. It's only $45. It's going to give you all the foundations that you need to decide all of these things. You know, what's the trend, all the basics, essentially. You know, if today was your first day, what do you need to know? That's what this program's aimed for. And then we've also got our profits training. You can again follow the links on the website, and this will give you, basically everything that you need, full end-to-end training, all the strategies, all the how do we select stocks, how do we get in, and a part of what we do is the strike selection that we've just been through right now, and you'll have immediate access to all of the training that's inside of the members area. So there's my unabashed presentation. If you do need more help, just know that it's available, and if not, that's cool as well. It's just great to have you here. So with that said, folks, it's a wrap. Thank you for your time. Thank you for your attention. This recording will be available in the Slack group. It's going to be available for 24 hours, and then it will be available in the members area. I'm going to start uploading them to YouTube. So for anyone who's got the basics program or any of the other programs that we have, you'll be able to watch this as many times at your leisure. Let me just press stop on the record. Just bear with me. Stop recording. There we go.